Okay, guys. So we're gonna get going. So this is basically this day day two of FAC 4863. So this is basically FAC 1. So yesterday what we did was we covered this is from, I don't remember which title it is from, but basically this question covers PPE and some impairment. Okay, not hectic impairment, basic impairment, but it covers those two aspects. So yesterday, we worked through part A, which is this luxury train, and we needed to account for the journal entries that happened for the current financial year. The current financial year is running from 1 March 2011 to 29 February 2012. Okay, so that is where the current financial year is. So they just wanted us to produce journal entries that based on the information over here, but only for the current financial year. So we explained how do you determine what are the possible journal entries. So if you acquire something in the current financial year, in the period you're busy with, then you'd have an acquisition, right? A purchase. If you sell an item of PPE in the period under review, then you'd have a disposal. So in this question, there was no purchase of a new item. There was no disposal of a new of a current item. Okay, so there's no disposals, no purchases. So there's no journal entry required for a purchase, no journal entry required for a disposal. Then the other common one would be is depreciation. Okay, so there would be depreciation in this question. Okay, so that is the three common journal entries would be an acquisition or a purchase, a disposal, and then depreciation. Okay, then there could be other items as well. Then there would be other items as well, such as, so what would be the other item? It would be, so, and this is typically for CTA 2, if you have a transfer, let's say an item moved from PPE to investment property, it can never be possible for this question, for this item, because this is a luxury train. A train can't be investment property. Okay, but an item could move from PPE to inventory. Okay, so if I decide that they buy and sell trains, then that can be a situation. Okay, but there was no transfers in this particular question. Similarly, another transfer would be from PPE to non-current assets held for sale. But once again, there was no planned sale of the luxury train, so therefore non-current assets held for sale was not applicable. So we went through typical things. Is there a purchase? No. Is there a disposal? No. There will be depreciation because we are using the train in the current financial year, so yes, there will be depreciation. Then we think of other specific items like transfers. Transfer from PPE to investment property, nothing. Transfer from PPE to inventory, there's nothing. And then transfer from PPE to non-current asset held for sale, there was nothing. So the other item you consider is an impairment. Okay, so you would consider an impairment if there is an indicator of impairment. If there's no indication of impairment, there's no need to test for impairment. But if there is an indication of impairment, then you must test for impairment. So this paragraph basically is an indicator of impairment. Okay, so there are two types of indicators, either an external indicator or an internal indicator. This here is highlighted, the paragraph has highlighted is an external indicator of impairment. So because there is an indication of impairment, we needed to test for impairment. Based on the impairment test, we had to process a journal entry for impairment. So if the carrying amount exceeds the recoverable amount, you will impair. If the carrying amount is less than the recoverable amount, you do nothing. So in this case, the carrying amount was more than the recoverable amount, so therefore we needed to impair. So the two journal entries we had was depreciation, and the second one was impairment. And the question or the required specifically told us also include deferred tax. And then we also did the deferred tax yesterday. Okay, so that is basically what we dealt with. The other aspect that was tested in this question was when you do depreciation, you need to have a look at other standards, other standards such as IAS 8, change in estimates, and then borrowing costs. So for CTA 2, borrowing cost is applicable. For CTA 1, it is not applicable. So there was no borrowing cost in this question, but there was a change in estimate. So therefore, we needed to calculate depreciation taking into account the change in estimate. The change in estimate will be one of two things, or both, change in useful life and or a change in the residual value. In this question, there was a change in the residual value, and as a result, we needed to factor that in when calculating our depreciation for the current year. So whenever you are faced with a question where there's a change in estimate in the current financial year, you always have to work out the carrying amount of that asset at the beginning of the current financial year. Because you're going to need that. You're going to need that to calculate depreciation for the current year and the years going forward. Okay, so just take note of that. So that is basically what we discussed yesterday. I'll share the video once I upload it to YouTube. Okay, so that was basically it over here. So today we're going to cover part B. So part B is just basically this, I think. Yeah, just this. So just the so this is basically Cape Town and Johannesburg plots. So we will walk through it again. Before I move on, what we also discussed yesterday is how do you determine what type of an item is it? So when you are reading a question, in most cases, because you are third year CTA already, it's basically in your mind to already identify that it's an asset, a liability, and so forth, right? But what you want to maybe try to get to as well is when you have extra time, not when you are learning. Okay, when you write under exam pressure, you don't still apply it. When you writing in an exam, you don't apply it because we should have applied it before the time, right? So what you want to get to is to distinguish between applying the conceptual framework versus applying an accounting standard. The conceptual framework is not an accounting standard. It is just the conceptual framework, okay? So one of the key aspects of a conceptual framework is dealing with, is basically helping you identify whether an item is an asset, liability, or equity. Once you have determined that it is an asset or liability or equity, the next part would be, so if you determine that this item is an asset, the next part is, so which accounting standard applies to this asset? So like yesterday, we were dealing with, so this question has some buildings in. So if you think about a building, okay, so now you establish that the building is an asset. So now you need to identify what type of an asset is it, or which accounting standard applies to this building. So you must try to get into the habit of running through your head the different accounting standards that we have learned that applies to an asset. That's how you're going to train your brain to think holistically, right? So the typical standards that we have that applies to an asset is PPE, IAS 16 PPE, IAS 38 intangible assets, IAS 40 investment properties, IAS 2 inventories. Then you have IFRS 9 financial instruments, but within financial instruments is financial assets. You have IFRS 16, which deals with leases. Within leases, you have lessees, which have right of use assets, or for lessors, which will have gross investment in lease and all of those type of stuff. And then the seventh one is non-current assets held for sale, IFRS 5. So for CTA 2 student, you want to run through all of those standards just to train your mind, okay? So even though you know it is PPE, just try to answer why it is PPE and why it is not the other standards. Just do it all the time to train your mind, right? So that is how you get used to it, so that when you read a question, because you've been training your mind to think like that, when you read a question, automatically your brain, without you thinking, your subconscious will push through the information that is relevant. So, for example, with the building, how we determine the building is an asset, but what type of an asset is it? Which accounting standard would apply to it? So we run through the accounting standards. IFRS 5. It can't be IFRS 5, which is non-current asset held for sale. Yes, it is a non-current asset, but it's not held for sale. So therefore, IFRS 5 do not apply. IFRS 9, financial instruments, specifically financial assets. It can't apply to a IFRS 9 can't apply because on both sides, we need cash or another financial instrument. In this case, it's a building. It's not cash. It's not another financial instrument. So IFRS 9 cannot apply. So IFRS 16, can it be IFRS 16? We're not dealing with leases, so therefore it's not IFRS 16. So IFRS 9 is out, IFRS 5 is out, IFRS 16 is out. Now we come to IAS 38. IAS 38, intangible assets. It can't be intangible assets because intangible assets has no physical substance. It is intangible. A building is tangible, so therefore IAS 38 do not apply. Okay, so now we ruled out. So we left with investment property, PPE, IAS2 inventories. So can it be inventory? Is a possibility. Can it be PPE? It's a possibility. Can it be investment property? It's a possibility. Okay. So in order for it to be investment property, it must meet the definition of investment property. The two critical parts would be it's held to earn rental income and or it is held for capital appreciation. If it is held to earn rental income and or it is held for capital appreciation and it is a building, land and buildings, then it will be investment property. If you in the business of buying and selling buildings in the ordinary course of business, that is what your business is about, of buying and selling buildings, then it would be inventory. If it is not held for, if the building is not held to earn rental income, or it is not held to earn capital appreciation, or it is not held with the intention to sell it in the ordinary course of business, then it's not IAS 38, it is not IAS 2, so then you're left with IAS 16. Generally, IAS 16 is like the default, okay? So IAS 16, if it's used in the production of income or it's owner occupied, then it will be IAS 16 PPE. So even though you can pick up from without needing to go through that process, you can pick up that it is IAS 16, it is an asset, it is IAS 16. Try to just train your mind to consciously think about it. Because the more you think about it consciously, it's going to linger in your head. And that will then form into your subconscious. So that will allow you, when you read a question, it will automatically come to you. So you don't have to all the time read consciously. So you must do this regularly for whatever you are studying, right? Just do it regularly, and that's how you're going to train your brain to think in a certain way. Okay, so that's very important, and this method of thinking is extremely important when the question is set in a manner that you need to figure out whether it's an asset or a liability or equity, and which accounting standard. So not all questions are set out to test that. But when the question is set out to test that, then it's a little bit more complicated, right? So then you have already trained your brain to think in a way to identify what type of an item is it. Okay, so let's read this question, and then we will read the required. So this required only has 3 parts, A, B, and C. Okay, we did A yesterday. We'll do B and C today. We'll start with C, and we'll come back to B. Okay, so they say Enjoy SA owns 2 plots in Cape Town and Johannesburg, which are used by staff members and clients to park their vehicles. Okay, so take note. So they have two items. It is used by staff members. So when it's owner occupied, then it is if it's owner occupied, then it is PPE, used to park client vehicles. So we'll go through IS 40. You will see investment properties to have a look what that is all about. Okay. The two plots were purchased on 1 March 2009. Enjoy SA decided to take up the offer of using the leased out office space for parking and therefore vacated the two plots on 1 November 2011. Okay, so Enjoy SA decided to take up the offer of using the leased out office space for parking and therefore vacated the two plots on 1 November 2011. Enjoy SA held the Cape Town office building for capital appreciation purposes on 1 November 2011. The following information about the Cape Town and Johannesburg plots is available. Okay. So the purchase price, 1 March 2009 is 500. Then we have fair value. And then we have fair value 28 February, 1 November. And we again have fair value 28 February 2012. Okay. Depreciation rate, straight line method, 2%. And SARS building deduction, now apportionment, 20 years. Okay. So they say it is the accounting policy of Enjoy SA to subsequently measure land according to the revaluation model. Enjoy SA has reevaluated its land to its fair value on 28 February 2011. Fair value is determined by using the market approach. The revaluation surplus is realized when the asset is derecognized. Investment properties are accounted for in terms of the fair value model. Okay, so let's have a look what the required is asking. Okay, so we're going to do part C. Let's say prepare the journal entries to account for the deferred tax implications regarding land in the financial statements of Enjoy SA for the year ended 29 February 2012. Show a separate journal entry for each deferred tax implication during the year ended 29 February 2012. Okay, so as usual, because I know deferred tax is a little bit more complicated for most of us, so I'm going to give you a little bit, even though it's only 7 marks, I'm going to give you a little bit extra time. So I'm going to put you guys into one group for you guys to discuss it and see what you come up with. Okay, so the first thing you need to identify is what happened during the financial year. So what you want to do is plot out. So our financial year is 1 March 2011 to 29 Feb 2012. Try to plot out what the events that happened throughout the year. Then you need to identify what type of an asset is it. And then you can, from there, you will be able to identify the accounting treatment. So draw a timeline, identify the events, identify what happened at each event, and what are the assets that we have. And then that will help you to determine the accounting treatment that needs to take place. Okay, so I'm going to put you now into groups. But before we go into groups, is there any questions that you may have? Is there no questions? Okay, so I'm going to put you guys into groups now. Okay, so I'm going to put you into groups and then join. Then you guys can discuss for the next few, like next 10 to 15 minutes.
Does everyone have it open now?
Yes.
Yes.
I think we all do, yeah?
Who would like to do the honors and do the speaking?
Anyone want to self-nominate?
I literally am lost, so I'm not going to
Give you 5 more minutes and then we're gonna close out, okay? Okay, guys, so how did that go? Any feedback?
So we lost a bit of time initially because
Okay, it looks like I don't know why I can't hear people. Let me just. Okay, I can see you trying to talk, Nolu, but I don't hear anything. I don't know what's the problem here.
Hi, can you hear me now?
But I need to sort this out because I can't sort it out now. So let
Okay.
me just jump back into this question. So remember the question wanted us only to deal with the journal entries relating to the deferred tax. So what I want you guys to do for me, right? I'm not going to do it in here. I'll do the journal entries, but what I want you to deal with is actually all the journal entries. Okay, so this question only asks us for deferred tax journal entries. But remember, deferred tax follows the underlying transaction. So to get the deferred tax right, you must know the underlying transaction. So what I want you guys to do is to do all the journal entries for the land for the current financial year. So basically, that is going from PPE to investment property and all of those type of stuff. Okay, so just take note of that. So in this question, we're having land and is moving from PPE to investment property was own occupied and now it's going to leased. Okay, and so therefore, because it's going from owner occupied to earning rental income, leasing, we will have to the land would be moved from PPE to investment property. Okay, now when we have that shift, okay, so when we have that change in intention, that transfer, the accounting standard, you will read it in IAS 40. IAS 40 deals with transfers, okay? So if PPE is accounted for on the revaluation model, you must account for PPE. You must do all the journal entries for PPE in terms of its accounting standard up until the date of transfer. And then on the date of transfer, you will take it out of PPE and then recognize it as investment property. Okay, so the revalued amount will become the cost price for investment property. Okay, so just take note of that. So I want you to do those journal entries and you must send it to me today, later today or tomorrow for the latest, but I will deal with the deferred tax entries. Okay, so now I'm going to share my screen and then we will deal with the deferred tax entries. Okay, so you should be able to see. So I'm going to deal with plot 1 first. Okay, then we can do plot 2 afterwards. You can do it in one set of journal entries, but I just want to keep it separate just so you can see what is happening. Okay, so for plot 1, we're dealing with our financial year 1 March 2011 to 29 February 2012. The event that took place during the year is on 1 November 2011. On 1 November 2011, there was a change in intention from owner-occupied to rent to leasing it out. Okay, so therefore, it goes from owner-occupied, which is PPE, to investment property. So what's happening over here, we need to account for the land from 1 March 2011 up until 1 November 2011, we need to account for it in terms of IAS 16 PPE. Then from 1 November up until 29 February 2012, we will then account for it as investment property. Okay, so the item that will draw deferred tax is the revaluation on 1 November 2011 and then the revaluation or the fair value adjustment on 29 February 2012. Okay, so basically I would have, let's just say date account. Okay, so the first thing for plot 1 is, the first thing that's going to happen is on 1 November 2011. On 1 November 2011, there was a change in intention, okay, from going from owner-occupied to leased, okay? So therefore, from PPE to investment property. IS 40 tells you need to account for a transfer. On the date of transfer, you must first account for the item based on its current standard, which is IS 16. So IS 16 says you need to revalue it up until that date. So therefore, we went, if I go back to the question, at the beginning of the year, 28 February 2011, we were on 530. Now on 1 November 2011, we need to do the revaluation. You can see it's decreasing. Okay, so the revaluation is decreasing. Because revaluation is decreasing, we would actually debit revaluation loss. Okay, we would debit revaluation loss. And we would credit land. So land would decrease, we'll say credit land, 5,000 Rand, debit revaluation loss OCI, 5,000. And then we will have the deferred tax on that. Okay, so because the deferred tax, because we're making a loss, it will be basically the deferred tax. If I'm just going to put it like this. So because we are making a loss, the tax impact will be an income to OCI. Okay, so we'll say credit revaluation. Okay, I'm just going to do it like that. Okay, and this is going to go to, sorry, not there. Okay, and this is going to go to OCI, and then we will have debit over here, which is going to be to a deferred tax SFP. Okay. So what is it going to be? It is the loss. It is going to be the loss. Okay, so we made a loss of 5,000. Because it is land, we will recover this asset through sale. Because we're recovering asset through sale, it will attract CGT. So we're going to take 80% of that times 28%. Okay, so we're making a gain. Why is the deferred tax a gain? Because the actual line item was a loss. Okay, the underlying transaction was a revaluation loss. So therefore, that will decrease our tax. A decrease to tax increases profit or loss. An increase to profit or loss goes on the credit side. Okay, so that is that line item over there. Okay, so now our land went from 530 to 525. So what would happen? The journal entry now would be credit land PPE 525, debit investment property 525. So now we first account for the revaluation. Then we remove land from PPE and we take it to investment property. Now investment property will run as is. Investment property applies is using the fair value model. So at year end 29 Feb 2012, there will be a fair value adjustment. So if you look at the question, the fair value adjustment is going from 525 up until 550. Okay, so therefore it's an increase. So the increase would have been, we're going to make a gain, a fair value gain, P&L, and then we're going to say debit investment property, 25,000 Rand. So because we are making a gain, therefore profits are increasing. Because profits will increase, tax will increase. An increase in tax decreases equity. Equity decreases on the debit side. So over here, we're going to have income tax, P&L, And then over here, we're going to have deferred tax balance sheet. Over here, the adjustment over here is going to be 25,000, which is 550 minus 525. That's also going to be recovered through sale. So therefore, it will be at the 28%. And it will be at the 80% recovery rate. So therefore, we will say multiplied by, it will be at the CGT rate, which is 80%. Okay. So just take note of that. Okay, so the important aspect over here is the following. There's two important aspects. Number one, where it is going. Because the underlying transaction related to PPE, revaluation goes through OCI. Okay. The second one relates to investment property. So the fair value gain goes through profit or loss. Okay, so it's very important. The second aspect is deferred tax in profit or loss section is included in income tax. Okay. For OCI, under the OCI section, there's no line item called income tax. We will just call it tax on the particular item. Okay, so just take note of that. So remember, both plots are now being used to earn rental. Both plots are being used to earn rental income. So because both plots are being used to earn rental income, they were first PPE and now they are being used to earn rental income. So they were owner occupied. Because they were owner occupied, they were PPE. Now they are used to earn rental income by leasing it out for people to park. So that implies they now become investment property. Okay. Okay, so just take note of that. Okay, so important aspect, OCI, P&L, income tax, the naming. Okay, so that's very important, take note. Okay, so now we'll do the second one. Okay, so the second one, same story. Okay, second one, same story. So what we're going to deal with over here now. So here we have on 28 February, we're sitting at that. Now we're going to have that fair value adjustment, and then we're going to have another fair value adjustment. Okay, so let's have a look. It's going from 1183 to 1150. Okay, so so it's an increase in this case. So therefore, the deferred tax OCI revaluation will be a debit. The deferred tax SFP will then just be on the opposite side. Let's just see how this one look now. It is 1183 to 1150. Okay. So 1150, 1, 2, 3 minus 1183. Okay. Multiplied by 80%, multiplied by 28%. Okay, so equal 1150, 1, 2, 3 minus 1183, 1, 2, 3 multiplied by 80% multiplied by 28%. Oh, it's also, wait, what am I doing over here? Let me just see quickly. 1183 to 1150. Okay, so that's actually a decrease. Sorry. That's actually a decrease. Let me just do this. Okay, so it is a decrease. So this must actually be like that. Okay, so because the revaluation was a decrease, the income tax would then be a increase. Okay. Okay, then the last one, it's simply going to be the exact same over here. Okay, let me just have a look at something quickly. Okay, then we're going to just have a 10,000 Rand increase. So in the last one, there was a 10,000 Rand increase, so be the same story. Okay, so that is basically what I think the answers should be. What you guys can do for homework is try to do all the journal entries, including the deferred tax, other journal underlying transactions as well, and then just compare if there was any error in my calculations. If there is, I'll just fix it up and then re-explain it again. Okay, is there any questions on your guys' side? Madunia, Unadi, Kennedy, Nalu.
Hi, can you hear me?
Hi, no questions on my side.
IFAs, can you hear?
Let me just see. I can't hear you for some other reason. Let me just quickly see what's wrong with my thing. Little sound. Mic. Let me just quickly see. Microphone setup. Let's try to speak now. Let me see if I can hear you now. Can you try to speak now? Let's just see if I can hear you.
Can you hear Faiz?
Kennedy, you speaking? No, still can't hear. Oh, man, I don't know why this is a problem.
Can you hear me? Mm. Hello?
Yeah, I don't think he can hear. I can hear you, Nolu.
You can hear me? Oh,
Yes, I can hear you.
Yeah, I can also hear you.
oh, so we can hear each other.
Yeah, I think it's more on Faiz's side.
Yes, no.
I don't know what's happening over here. How did we establish that plots are both at IS40? Oh, so yes, there's something wrong with my speakers. It seems for some odd reason. I don't know what's happening over here. So what I wanted to say now. So both plots are owner occupied. Okay. Both plots are owner occupied, so both are PPE. On 1 November 2011, both plots are being used to lease out to earn rental income. So the fact that we are leasing it out to earn rental income, it meets the definition of IS40 investment properties. So that is why both gets transferred out. Right? That is the reason, basically. Hope that answers the question. Madania, you have any questions? Hunadi, Kennedy? Nolu, you can just let me know if that answers your question. Madania, any questions? Hunadi, any questions? Kennedy?
No questions from my side.
I can't hear, sorry. You can send me a voice note and then I can listen. Okay, if there's nothing else, we guys good to go. Okay, guys. I will send an updated timetable to do the catch up of the 2 FAC classes, and that's supposed to happen this weekend. We'll definitely have it by next weekend. Okay. Thank you very much, guys. I'll see you next week. Those that are in the CTA2 group, we will discuss during this week again. And I'll share some notes as well. Those are in the CTA mastermind. So so some people is on here, they're just joining the workshops. Some people is on here because they're part of the CTA2 mastermind. So it was part of the CTA2 mastermind, will be in the CTA2 mastermind group. And over there we'll do some extra stuff. And also I need to follow up on some of the where we need to do some homework as well. Yeah. Okay, so if you want to join the CTA2 mastermind, if you are in CTA2, it's also applicable for CTA1 students, then you can. We just have 2 spots remaining. And then I'm going to close it. Okay. Anyway, guys, I'll see you guys. Bye-bye.